A 1% leak can ruin your future more effectively than a bad stock pick. That sounds too small to matter. That is exactly why it is dangerous. Most people think they lose money because they chose the wrong company, mistimed the market, or panicked in a crash. Those mistakes are obvious. They leave bruises. They embarrass you. You remember them. The far more expensive mistakes are the quiet ones. I have spent my life watching capital behave. I have watched it sprint, stall, multiply, decay, hide, migrate, and disappear. And one of the most expensive lessons in all of investing is this. Money does not need to be punched in the face to die. It can bleed out through small leaks that feel harmless, respectable, even intelligent. That is the ETF trap for many ordinary investors. You buy a fund because it looks sensible, it is diversified, it is familiar, it sounds safe, it looks like adulthood, it looks like prudence. You tell yourself that time will do the heavy lifting, and sometimes time will, but only if the container is not leaking. That is the frame I want you to hold all the way through this conversation. Your portfolio is not just a collection of tickers. It is a container, a vessel, a tank holding years of labor, sacrifice, delayed gratification, and future freedom. And most people spend all their energy worrying about what is being poured into the tank while paying almost no attention to what is quietly draining out of the bottom. That is not 10 million error, that is a life error. Because your future does not care whether you were fooled by something dramatic or by something boring. Lost money is lost money. Lost compounding is lost freedom. Lost freedom is lost life. When I was young, I learned very early that capital has a temperament. It rewards discipline, but it also punishes sloppiness with unusual cruelty. The punishment is especially severe when the sloppiness repeats automatically year after year. That is why a small leak in a portfolio often does more damage than one foolish gamble. A foolish gamble might hit you once. A leak charges you forever. And ordinary people love leaks because leaks do not make them feel stupid. That is the first thing you need to understand. If you buy some absurd speculative thing and it collapses, the pain is public and immediate. Your ego gets burned, your confidence gets hit, your mistake is visible. But if you buy a respectable fund with a polished fact sheet, a reassuring name, a decent-looking yield, and an annual fee that seems tiny, you can sit inside that mistake for 15 years while telling yourself you are being responsible. That is how financial damage becomes permanent. It hides inside respectability. So let me give this mechanism a name. I call it the compound leak. The compound leak is any portfolio feature that quietly drains return, attention, or decision quality year after year, while allowing you to keep feeling rational. The ETF world is full of these leaks because ETFs are convenient, accessible, and easy to trust. I like simplicity, I like access, I like tools that ordinary people can use without a PhD. I have no war with ETFs. In many cases, they are exactly the right vehicle. But a good vehicle with a hole in the fuel line will not take you where you think it will. That is where most people go wrong. They think the label ETF means safe by default. It does not. It means container. And containers can leak. The first leak is the one that looks the smallest and ends up costing the most fees. If you are careless with expenses, you are not investing. You are volunteering part of your future to somebody else and calling it diversification. I want you to think about how absurd this is. You work for money, you pay tax on money, you save what is left. You take risk with what remains. You accept uncertainty. You endure market declines. You wait for years. Then after all that, you casually allow a fund company to siphon off a noticeable slice of your eventual outcome because the fee looked harmless on a screen. That is not prudence. That is passivity wearing a tie. A fee is not a one-time annoyance. It is a yearly claim on your capital base. It is taken whether you had a good year or a bad year. It is taken whether the market bailed you out or punished you. It is taken on the whole pile, not only on the gain. And the moment you understand that, you stop treating expense ratios like tiny footnotes. You start seeing them for what they are. Permanent leaks. People hear 1% and think, that sounds trivial. They hear 50 basis points and think, that cannot decide my future. But compounding is a machine of repeated years, not a machine of first impressions. Small differences repeated over long stretches become large confiscations. Take a simple case. Suppose you put $200,000 into an ETF, The underlying investments earn 10% before fees. That sounds healthy, respectable, sensible. One fund charges 1%. Another charges 5 basis points. Not 5%. 5 basis points. The difference in annual drag does not look like a drama. It looks like a rounding error. Over 15 years, it can turn into a figure gap, no better timing, no smarter stock picking, no miracle, just less leakage. One path leaves you with far more of your own return. The other path leaves a meaningful portion of your future sitting in somebody else's revenue line. And the worst part is that the investor in the expensive fund often never feels robbed. He sees growth, he sees progress, he sees no scandal, he sees no emergency. He simply arrives in the future with less than he should have had. That is how the compound leak works. It steals without spectacle. And because it steals without spectacle, people postpone learning the lesson. They tell themselves they will optimize later. They tell themselves the fund has a strong track record. They tell themselves it is only 1%. They tell themselves they are being too nitpicky to care. No, nitpicky is exactly how serious investors survive. A serious investor is not somebody who makes life complicated. A serious investor is somebody who refuses unnecessary leakage. That is one of the great dividing lines between people who merely participate in markets and people who actually allocate capital with self-respect. The first group looks for stories. The second group looks for drag. The first group asks, what could go right? The second group asks, what will keep leaking if I do nothing? That is a much better question, because compounding is generous, but it is not sentimental. It will not protect you from carelessness. If you feed it extra drag, it will compound the drag. If you reduce friction, it will compound the benefit. The machine is neutral. It amplifies what you build into it. So the first repair is obvious. Before you get excited about theme, sector, narrative, dividend, chart, talking head, or recent performance, check the expense ratio, not as a formality, as a gatekeeper, as a first filter. As the first patch on the tank, I am not telling you that the cheapest fund is automatically the best fund. Price alone is not quality. A low fee does not transform a poor structure into a good one. But ignoring fees almost guarantees that you are accepting unnecessary drag before the race even starts. And let me be blunter. If two products give you broadly similar exposure and one quietly takes much more from you every year, you are not making a sophisticated choice by selecting the expensive one. You are paying tuition for the privilege of not reading carefully. That is not the kind of tuition I admire. Now let us move to the second leak, and this one is more psychological. This one is dangerous because it does not look like a leak at all. It looks like income, it looks like progress, it looks like money arriving in your account. That is why I call it the yield mirage. A lot of people fall in love with dividend yield for the wrong reason. They do not love it because they understand capital allocation, durable cash flows, payout discipline, and total return. They love it because little cash deposits feel emotionally satisfying. That feeling is real. It is also expensive when it overrides judgment. The human brain loves visible rewards. A quarterly payment feels like proof. It feels like the portfolio is working. It feels like the machine is finally producing something tangible. And if you do not have much wealth yet, those first little deposits can feel intoxicating. They make you feel like an owner. They make you feel like you cracked the code. But your account is not a mood board. It is a balance sheet. And a balance sheet does not care whether the cash distribution gave you a pleasant sensation if the asset underneath is slowly deteriorating. This is where ordinary investors get trapped. They confuse payout with progress. A high yield can be healthy in the right context. I am not hostile to distributions. I am hostile to shallow thinking. If a fund yields 6 or 7%, but the underlying principle is eroding, you are not harvesting fruit from a thriving tree. You may be watching the tree die while congratulating yourself on the falling apples. That is not income. That is liquidation wearing perfume. I want you to picture two investors. Both put $100,000 into income-oriented ETFs. One sees $6,000 or more show up over the year and feels thrilled. He tells himself his money is finally working. He starts imagining future passive income. He relaxes. But if the underlying fund drops tens of thousands in value over time, that income did not solve the problem. It disguised it. This happens all the time. People chase yield and ignore the body that is producing the yield. They focus on the dripping faucet and ignore the collapsing water tank. A fund can pay out attractively because the underlying assets are under pressure, risky, heavily indebted, rate sensitive, structurally stagnant, or simply priced to compensate investors for fragility. That does not make the yield fake in a technical sense. It makes the investor's interpretation of it dangerously incomplete. And incompleteness is where losses breed. What most people need to learn is the difference between cash movement and wealth creation. Cash movement is money arriving. Wealth creation is net worth compounding after costs, taxes, inflation, and capital decay. Those are not the same event. If you fail to separate them, you will build a portfolio around emotional reassurance rather than economic truth. That is how the yield mirage drains people. It gives them something to celebrate, while something larger is quietly breaking. So I want to give that bias a second name. Dopamine income. Dopamine income is any payout that feels so satisfying in the moment that it distracts you from asking whether the asset itself is actually becoming more valuable, more resilient, or more productive over time. That is a brutal trap for new investors, because new investors are starved for confirmation. They want evidence that the process is working. They want to feel smart. They want the machine to talk back. A little distribution feels like applause. But markets are not there to applaud you. Markets are there to transfer money from the impatient, the shallow, and the easily flattered to the disciplined. A serious investor does not ask only, "How much does this pay me?" A serious investor asks, "What am I giving up to receive this payment?" That question alone will rescue you from a tremendous amount of nonsense. What is the long-term return profile? What is the total return? Not merely the cash yield. What is happening to principal over time? What kind of assets are underneath this payout? What risks are being smuggled into this income stream? What does the full history look like when you zoom out beyond 1 year, beyond the recent cycle, beyond the promotional frame? You would be amazed how many seductive products collapse the moment you ask those questions. Most people do not ask why, because they were not sold analysis. They were sold a feeling. And that takes us to the third leak, which is often the leak that creates the first two: media-driven persuasion. This may be the ugliest leak of the bunch because it does not just drain return, it drains judgment. I call it the headline leak. The headline leak begins the moment you let somebody else's urgency become your investment process. You see a flashy article, a dramatic thumbnail, a bold claim, a best ETF to buy now, a high-income fund paying double digits, a must-own opportunity before it explodes, a recent performance table, a celebrity quote, a phrase designed to trigger greed before scrutiny, and financially literate. You mistake stimulation for research. That is one of the costliest confusions in modern investing. Most financial content is not designed to protect your capital. It is designed to attract your attention. That is a different business model. Attention businesses need novelty, drama, urgency, conflict, and emotional hooks. Boring truth does not monetize as aggressively as exciting possibility. A disciplined, repeatable, low-fee, decades-long strategy is not a very sexy headline. It does not trigger the same clicks as a piece promising huge income market, beating upside, or someone's, in a decade angle that makes ordinary patience sound obsolete. And because people are bored by discipline, they get seduced by stimulation. That is where the leak becomes cultural. It is not only that one article misleads you, it is that repeated exposure trains you to think like a consumer instead of an owner. A consumer of financial content wants excitement. An owner of capital wants accuracy. A consumer wants updates. An owner wants durable process. A consumer asks, "What is hot?" An owner asks, "What is sound?" Those are radically different mindsets. If you live inside headlines, your portfolio will start to reflect the incentives of the publishing industry rather than the economics of the underlying investments. You will drift toward what is marketable. You will overweight story. You will underweight structure. You will stop reading the actual investment and start reading the social theater around it. That is how judgment leaks out. And once judgment leaks out, everything else follows. You pay too much in fees because the product was well branded. You chase yield because the payout looked irresistible. You buy the narrative because the recent chart looked persuasive. You trust the headline because it arrived wrapped in confidence. This is not a small problem. This is how entire generations of investors get pushed toward products they do not fully understand. Let me tell you something harsh. If a headline is engineered to trigger your emotion before your analysis, you are not the reader. You are the product. That does not mean all financial media is useless. Not at all. Data sources matter, news matters, metrics matter, primary documents matter. I have no objection to information. My objection is to persuasion masquerading as information. There is a big difference between a source that helps you inspect reality and a source that pressures you to adopt someone else's conclusion. One educates your process. The other hijacks it. That is why I tell people to go directly to the investment itself. Look at the expense ratio. Look at the underlying holdings. Look at the long-term chart. Look at total return. Look at turnover. Look at concentration. Look at how the product behaved through stress. Look at what problem it actually solves. If the case for owning something disappears the moment you strip away the article, the host, the chart framing, the yield sticker, and the emotional pitch, then you never had an investment thesis. You had marketing residue, and residue is not enough to carry you across decades. I want to pause here because the real issue is not ETFs. The real issue is what kind of investor you are becoming. That is the larger story beneath all three leaks. High fees tell me you are not defending your future carefully enough. Yield chasing tells me you are too eager for visible rewards. Headline dependence tells me you are borrowing conviction from strangers. All three point to the same disease. You want the feeling of progress more than the mathematics of freedom. That is a dangerous way to live financially, because freedom is mathematical long before it becomes emotional. Freedom comes from owning assets that compound with minimal leakage over long periods of time. Freedom comes from refusing to pay for theater when plain structure will do. Freedom comes from selecting vehicles that keep more of the machine working for you rather than for intermediaries. Advertisers, managers, or your own impatient brain, and freedom requires boredom. That sentence offends a lot of people. But it is true. If you want a life with lower stress, more refusal power, and more control over your time, you will probably have to build it through methods that feel unglamorous in the moment. Watching paint dry is closer to successful investing than watching fireworks. Fireworks are exciting because they burn themselves up quickly. Drying paint is useful because it becomes part of a structure that lasts. Most people choose fireworks and call it ambition. Then they wake up years later and discover that their account grew, but not as much as it should have, that their income arrived, but not in a way that built durable net worth, that they stayed engaged, but not in a way that improved decision quality. They were active, they were not effective. Now let us go deeper. Why are these leaks so hard to eliminate? Because each one flatters a weakness most people already have. Fees flatter laziness. A high expense ratio says, do not worry about the details, just trust the wrapper. Yield flatters impatience. A big payout says, you do not need to wait for real compounding. Here is your little reward now. Headlines flatter insecurity. A persuasive article says, you do not need your own process. Borrow this confidence and feel informed. That is why leak management is really character management. The investor who patches leaks is not merely more informed. He is less needy. He does not need a fancy wrapper to feel sophisticated. He does not need a high payout to feel validated. He does not need financial media to tell him what to think every week. He can sit with simple, durable logic that is rare. And rarity is valuable. I have always believed that rationality is a competitive advantage, but most people misunderstand what rationality means. They think it means being very smart. Not necessarily. In practice, it often means being less distractible, less vain, less urgent, and less emotionally breathable than the crowd. That is exactly what good ETF behavior demands. Do not overcomplicate the task. You are not trying to outdazzle the market. You are trying to build a container that leaks as little as possible, and then keep feeding it over time. That is a much more humble goal. It is also a much richer one. If you make that shift, a lot of confusion disappears. You stop asking, which ETF feels exciting? You start asking, which structure preserves the most of what I earn? You stop asking, which fund pays the biggest distribution? You start asking, what combination of growth, resilience, cost, and simplicity will best protect my compounding? You stop asking, what are people talking about? You start asking, what does the investment itself actually do? That is the system shift. And once that shift happens, your whole relationship with money changes. You begin to see that the game is not only about adding returns, it is about subtracting leakage. That is true far beyond ETFs. In business, leakage comes from bad incentives, weak culture, sloppy inventory, unnecessary debt, poor pricing, and managers who confuse activity with output. In life, leakage comes from status spending, bad relationships, disorganized time, untreated impulse, and environments that make self-control expensive. In investing, leakage comes from cost, taxes, turnover, leverage you do not understand, products you cannot explain, and stories that make you feel informed while keeping you shallow. Different arena, same law. If you do not protect the container, the contents will not save you. I want to speak directly to the person who is just getting started, because this is where a huge amount of future wealth gets quietly damaged. In the beginning, you will be tempted to treat small differences as irrelevant, because your balance is small. That is backwards. Small balances are exactly when habits are being written. Small balances are when your standards are being set. Small balances are when your default filters are either being installed or neglected. If you learn to tolerate leakage early, you will keep tolerating leakage later, only with more money at stake. That is why beginning investors must become leak fanatics. Not paranoid, just disciplined. Check the fee, check the structure, check the total return history, check what the yield is actually attached to. Check the holdings, check whether you understand the job the ETF is supposed to perform inside your portfolio. If you cannot explain in plain language what the fund owns, what it charges, why it belongs, what role it serves, and what could go wrong, you are not ready to own it in size. That may sound severe. Good. Severity is often kindness in money. Soft language has destroyed enough people already. There is another mistake tied to all this, and it is subtle. People often think that once they have identified one leak, they are safe. They move to a cheaper fund, or they stop chasing yield, or they become more skeptical of articles, and then they relax. But leak management is not a one-time repair. It is a permanent posture. The financial industry is always finding new ways to package stimulation as strategy. New themes, new wrappers, new urgency, new income stories, new complexity sold as sophistication. If your standards are not continuous, your discipline will get renegotiated by every new cycle of marketing. That is why you need an inner scorecard in investing. Not just in ethics, not just in work. In investing, an investor with an outer scorecard buys what sounds impressive. An investor with an inner scorecard buys what survives scrutiny. An outer scorecard investor wants to be seen making smart moves. An inner scorecard investor wants to quietly arrive where he intended to go. That difference seems philosophical. It is actually financial, because the louder your investing identity becomes, the easier you are to manipulate. The more you need your portfolio to flatter your intelligence, the more susceptible you become to expensive wrappers, seductive yield, and story-driven noise. The best portfolios do not perform for your ego. They perform for your future, which means you must be willing to look boring while becoming free. That is the trade. Many people will never take it. They will continue paying too much for broad exposure because they did not want to read the details. They will continue reaching for yield because income felt emotionally satisfying. They will continue absorbing financial headlines as if attention, rich content and truth, rich analysis were the same product. Then they will call the result bad luck. It was not bad luck. It was tolerated leakage. I do not say that to insult them. I say it because naming the disease correctly is the first step in escaping it, and escaping it is not complicated. The escape path is simple enough that many people will reject it out of boredom. Use low-cost, understandable structures when broad exposure is the goal. Treat every fee as a recurring ownership claim against your future. Judge income products by total outcome, not by the pleasant drip of cash alone. Treat yield as one metric, never as the whole story. Use media for raw input, not borrowed conviction. Verify claims, Read the actual fund. Prefer clarity over stimulation. Prefer structure over emotion. Prefer process over headlines. That is how you patch the tank. And once the tank is patched, something almost magical happens. Compounding starts looking less magical, it starts looking mechanical. That is exactly how it should look. You put money in, you minimize leaks, you let time work, you keep your hands and your ego from sabotaging the machine, you repeat. The reward for doing this is not only a larger account, the reward is dignity. There is a special dignity in knowing your portfolio is not built on confusion. There is a special calm that comes from knowing you are no longer paying hidden tribute to every polished product and every emotional headline that crosses your screen. There is strength in understanding your own structure well enough that you do not need constant excitement to stay committed. And that calm matters, because the investor who needs excitement will eventually buy trouble. The investor who can tolerate clarity will usually buy better. I have watched enough lives to know that wealth is rarely destroyed by one dramatic act alone. More often it is weakened by tolerated inefficiencies, emotional bribes, and repeated little mistakes that nobody thought were worth fixing. Then one day the person looks up and realizes that years passed. Effort was real, income was earned, discipline was attempted, and yet the outcome feels thinner than it should. That thinness has a source: leaks. You do not patch them because it is fashionable. You patch them because every dollar that remains in the container is a future choice preserved. A preserved choice is not just a number. It is the ability to say no to a bad boss, no to panic, no to selling at the wrong time, no to staying trapped, because your portfolio never became what it could have been. That is the final point I want to leave you with when you ignore ETF leaks. You are not merely losing return. You are selling future refusal power in exchange for present convenience, present stimulation, and present emotional comfort. That is too expensive. So here's the test. The next time you are tempted by a fund, do not ask whether it feels safe. Do not ask whether it sounds smart. Do not ask whether the yield looks satisfying. Do not ask whether the headline is persuasive. Ask one harder question: where is this thing leaking? If you cannot answer that question, you are not ready to own it. If you can answer it, and the leaks are small, visible, tolerable, and understood, then you may finally have something useful. That is how adults invest, not by chasing the most exciting stream, by protecting the container. And now you have a choice. You can keep buying financial products the way most people do, with a wandering eye, a stimulated mind, and a leaking tank. Or you can become the kind of investor who treats every basis point, every payout story, and every headline as a test of discipline. One path keeps you entertained while your future quietly drains out. The other path looks boring for a long time and then gives you something very few people ever earn: a container that holds a machine that works, a future that does not leak away while you watch.